When the global financial crisis struck, the sophisticated mathematical models that banks used to measure their own risk failed. Today, global regulators are implementing a strict new system to fix those historical failures, just as an influx of highly volatile digital assets tests the boundaries of modern finance. The flaw of the pre-2008 Basel II framework was a matter of trust. Regulators granted the world's largest banks the freedom to use their own internal models to calculate their risk, and by extension, the amount of capital they needed to hold to survive a crisis. This pure risk sensitivity approach had a disastrous side effect. Because models look at historical data, they told banks they needed almost no capital when markets were calm. When market stress finally peaked, the capital buffers had mathematically vanished. The global regulatory response is the Basel III final reforms. This is a rigid, internationally coordinated architecture specifically designed to dismantle the banking sector's reliance on opaque, optimistic modeling. But this regulatory lockdown is hitting the market at the same moment a complex, technologically novel asset class enters the financial system. This new digital influx arrives in three distinct categories: tokenized representations of traditional assets, fiat-referenced stablecoins, and unbacked cryptoassets. The Basel Committee does not grant these digital instruments an exemption from the new rules. Instead, cryptoassets are forced directly into the exact same architecture restricting traditional balance sheets. To understand how global regulators will allow banks to handle cryptoassets, we first have to deconstruct the mechanical constraints of the Basel III Endgame itself. A digital asset can only survive on a bank's balance sheet if it passes the exact same standardized measurement and the exact same output floor, currently restricting traditional global finance. For years, sophisticated banks used advanced internal ratings-based, or IRB, models to calculate their credit risk. By proving to regulators that their portfolios were exceptionally safe, these models reliably lowered a bank's regulatory capital requirements. This chart illustrates the regulatory correction. On the left is the low capital requirement a bank's internal model might produce. On the right is the revised standardized approach, a granular, globally uniform baseline applied to those exact same assets. To prevent banks from modeling away their risk, Basel III introduces its ultimate failsafe, the output floor. The math is absolute. A bank's final risk-weighted assets denominator can never drop below 72.5% of the total calculated under the standardized approach. The immediate strategic consequence is a ceiling on optimization. Investing in predictive risk models no longer guarantees lower regulatory capital requirements. Because this floor is calculated on the aggregate, banks are now forced to maintain two parallel infrastructures. They need one system running their approved internal models and a data architecture executing the standardized calculation. Management teams must now reprice their balance sheets. Credit portfolios that previously generated high returns under aggressive internal model assumptions suddenly require far more capital. The output floor effectively cages the internal models. Regulators intentionally sacrifice tailored risk sensitivity to guarantee verifiable prudential comparability across the global banking system. Beyond credit risk sits operational risk. This is the financial threat posed by failed internal processes, cyber incidents, internal fraud, and legal liabilities. Previously, banks were permitted to use advanced measurement approaches to model this specific risk. Under the final reforms, those predictive models are entirely abolished. This equation represents the universal replacement for all operational risk models. It dictates a bank's operational risk capital using just two strict variables. The first variable is the business indicator component. This acts as a proxy for the bank's operational scale, pulling hard inputs directly from the income statement, including interest, services, and financial activity. The second variable is the internal loss multiplier. This is a scaling factor tied directly to a bank's specific operational track record, calculated using a 10-year historical loss window. The mechanism is punitive. If a bank suffers severe operational failures, or if it simply has poor internal loss data governance, the multiplier mechanically forces their capital requirements higher. This strict reliance on data directly impacts corporate strategy. If a bank acquires a new financial tech company, they legally inherit that company's historical loss data, instantly altering their own internal loss multiplier. Operational risk capital is no longer a forward-looking modeling exercise. It is an unavoidable, mathematical tax levied on a bank's scale and its past systemic failures. It is into this heavily constrained architecture that digital assets must now fit. The Basel framework dictates this through a specific exposure-based classification matrix known as SC060. The first boundary condition is strict. Central bank digital currencies are entirely excluded. The framework applies specifically to private cryptoassets. This diagram maps the core philosophy of the framework: economic substance over technological label. A digital asset enters the top of the matrix and must navigate a series of logic gates to determine its prudential bucket. The first classification is Group 1A, covering tokenized traditional assets. For a digital bond to land here, it must possess the exact enforceable legal rights of a traditional bond and guarantee settlement finality on the distributed ledger. Next is Group 1B for stablecoins. Simply pegging a token to fiat currency is insufficient. The asset must pass tests proving reserve quality, strict issuer regulation, and legal redemption rights during market stress. If an asset is entirely unbacked, like Bitcoin or Ether, or if a tokenized asset fails any of its structural tests, it drops directly into the Group 2 penalty bucket. Group 2 is then subdivided into 2A and 2B. This distinction is based entirely on whether the asset meets the market liquidity and trading thresholds required for regulators to legally recognize risk hedging. Falling into Group 2B triggers the most severe treatment. The bank faces punitive, conservative capital charges with zero allowance for hedging or risk mitigation. Applying a distributed ledger to an asset does not grant it a regulatory bypass. If a tokenized asset carries ambiguous legal title, the Basel matrix immediately downgrades and penalizes it. To see this in practice, placing a tokenized bond on the balance sheet instantly draws two distinct lines: credit risk and operational risk. The credit risk line hits the 72.5% output floor. Simultaneously, the operational risk line routes into the BIC and ILM formula. The infrastructure that makes the tokenized bond function, the smart contracts, the cryptographic key management, and the custody requirements, directly inflates the bank's operational scale, and therefore its capital requirement. This operational tax applies even if the asset never touches the balance sheet. Merely providing custody services for client crypto assets generates risk capital through service fees and heightened cyber exposure. These cumulative burdens reflect a shift in how global banking authorities operate. The transition from Basel II to Basel III marks a move away from trusting internal mathematical models toward enforcing comparable, verifiable evidence. A bank cannot simply ask what the capital charge is for a new stablecoin. First, it must prove the asset's legal rights, demonstrate its operational controls, and ensure its data architecture meets the standardized baseline. Crypto assets are not an exemption to the rules of traditional finance. Their complexity, volatility, and technological dependence make them the ultimate, unforgiving stress test of the most constrained capital framework in modern banking history.